Good morning. You're listening to Nolan Financial Radio. I'm your host, Chris McKinney, with Nolan Financial Partners here in Colorado Springs. Whether you're driving to work, sitting down with morning coffee, or starting your day at the kitchen table, I'm glad you're with us, because what we are going to talk about over the next about a half hour could have a bigger impact on your financial future than any single investment decision you've probably ever made. We're going to talk about something called Advisor Alpha. So now you might be thinking, Chris, I know what alpha means. That's the extra return you get by picking the right stocks at the right time, right? Well, yes and no. The word alpha does mean extra return, but Advisor Alpha is something different. And honestly, it's something more powerful. Advisor Alpha is the measurable, documented, research-backed value that a good financial advisor adds to your retirement outcome. Not through stock picking, not through market timing, but through smart strategy, disciplined planning, behavioral coaching, and tax efficiency. It's the difference between what you earn and what you keep, between your portfolio, what your portfolio generates, right, and the return that actually ends up in your pocket. So today we have some fresh data to anchor this conversation from Dalbar. It's a premium independent research firm in the financial services industry. Just released their 2026 quantitative analysis of investor behavior. 32 years of research into how real investors actually behave in real markets. So what they found has important implications to everybody that's listening to this right now. We're going to unpack all the data. We're going to talk about the 4 pillars of the Advisor Alpha, and I'm going to tell you what it all means for you, specifically, concretely, and practically. Okay. Before we get started, this is not a hypothetical story. It's a real pattern that plays out in millions of American households every year. In late 2024, the market has been on a remarkable run. A lot of people have been watching from the sidelines, frustrated, feeling like they missed it. So they jump in confidently, enthusiastically. They buy. The market creeps, climbing through the first part of 2025. Then comes July. The headlines get nervous. Volatility picks up. Uncertainty creeps in. And people start doing what people have always done when fear gets involved. They sell. In fact, Dalbar's 2026 report shows that in July of 2025 saw the single highest monthly withdrawal rate ever recorded. Investors pulling 2.3% of assets out of the market in 1 month. That's 1 month. That's a record going all the way back to 1985. So here's the painful part. The market didn't collapse. It kept going. And those investors who sold in July missed what came next. So the S&P 500 returned 17.88% in 2025. Average equity investor, they earned 17.16%, a gap of 72 basis points. Now, in a good year, that might sound acceptable, but Dalbar's data shows something important. The gap was so much smaller than usual because 2025 was an unusually strong year where even the panic sellers recovered some ground, right? So in 2024, just 1 year earlier, behavior gap was 848 basis points. That's 8.48%. Okay. So basically 8.5% difference in what somebody made and then what the equity investor made, right? Somebody that knew what they're doing, somebody that didn't know what they're doing. Not a rounding area. That's life-changing money left on the table. So what causes this gap? What creates this gap? So why do investors consistently underperform the very funds they're invested in? Well, it's not stupidity. It's just not laziness. It's something far more fundamental. It's human wiring. Our brains evolved over hundreds of thousands of years to respond to threats quickly. See a predator, run. Feel danger, act. That system deserves our ancestors. That system served our ancestors incredibly well. Excuse me. When they were in the savannah, running from the lions, uh, they ran. So it serves us not so good in financial markets. When markets drop, our brains perceive a threat. The fear response fires. The rational, planning oriented part of our brain, the prefrontal cortex, gets temporarily overwhelmed. And we do the one thing that feels right, and it's almost always wrong. We sell at the bottom to stop the pain. So, Vanguard's research has quantified this for years. Their advisors alpha framework estimates that behavioral coaching alone, just helping investors stay disciplined and avoid emotionally driven mistakes, is worth approximately 1.5% per year in additional returns. That's 1.5%. It's not a huge number. But that's every year. And it's not from picking better stocks. It's from staying out of your own way. Now think about what 1.5% means over 20 years. On a $500,000 portfolio, there's between 6% and 7.5% annual growth over 20 years is roughly $480,000. That's nearly $500,000. Not because of some brilliant strategy, some investors, making super great decisions. It's because someone sat across from you during the scary moment, said, stay the course. This is why we built the plan we built. That is Advisor Alpha. And it's just one of the 4 pillars we're going to talk about this morning. So you just heard about the behavior gap and the real cost of navigating markets without a guide. At Nolan Financial Partners, we exist to close that gap for you. Right now, we're offering a complimentary retirement consultation, no cost, no obligation, just a real conversation about where your money is going and how we can help you keep more of it. This isn't a sales pitch, it's a strategy session. We look at your current plan and identify where your value may be eroding through taxes, costs, or missed opportunities, and talk through what a stronger strategy looks like for your particular situation. So call us today, 719-210-4242. That's 719-210-4242, or visit us online at nolanfinancialpartners.com. Your retirement should not have to wait. Okay. So we've established the behavior gap, the proven, documented tendency for investors to underperform their portfolios because of emotional decisions. Well, let's talk about the solution. Let's talk about the 4 pillars of Advisor Alpha and what each one means in real dollars for real people approaching retirement. So, pillar 1, behavioral coaching, which can get you about 1.5% per year, as we talked about. So we kind of covered that, but I'm going to add another layer to it. So the value of behavioral coaching isn't just in the big moments, the market crashes, the panics, the headlines that say everything is on fire. It's also in the quiet moments, the conversation where your advisor says, I've noticed you've been heavy in cash for 6 months. Let's talk about what's holding you back. The check in where they walk through your allocation, say, does this still match your goals? You've built up $100,000 in your savings in your bank account. What's going on with that? So Morningstar's research on what they call the mind gap found that over the decade ending in December 2024, the average dollar invested in the U.S. mutual funds and ETFs earned 7% per year, about 1.2 percentage points less than those same funds' stated returns of 8.2%. That 1.2% gap is entirely attributed to investor behavior, to buying high and selling low, to switching funds at a bad quarter. A good advisor closes that gap, not perfectly, not always, but consistently and meaningfully over time, and consistency is what compounds. Here's a question I want you to sit with. For pillar 2, we're going to talk about tax efficiency, okay? So the question is, Do you know how much of your portfolio growth you're giving back to the IRS each year? Most people have no idea. And the answer would probably surprise them. So, tax drag, right? The erosion of returns caused by inefficient tax treatment of investments. This is one of the most significant and most avoidable resources uh, a source of your retirement. I'm sorry, I'm having a moment here because taxes. If you get hold of your taxes and you understand what you're doing with them, they won't. You won't let them destroy your wealth, right? And so they're a big part of what eats up wealth. So the advisor research estimates that tax smart strategies can add 0.7 to 1% in after tax returns annually. That's a big deal annually, right? So what does that look like in practice? So it means placing the right assets in the right accounts, interest generating bonds, and dividend hitting funds often belong in tax deferred accounts like IRAs, where that income does not trigger a tax bill this year. Growth oriented, tax efficient investments often make more sense in taxable accounts where gains can be managed and timed strategically. So it also means tax loss harvesting. So strategically selling positions that are down to realize a loss that offsets some gains somewhere else in your portfolio. So it means planning your withdrawal sequence in retirement. Which accounts do you pull first and in what order to minimize what you owe each year? In 2026, it means having a conversation about Roth conversions. So Roth conversions are something that we do quite well here. We have a big plan. We'll sit down and make work for you, right? So if you have substantial money in traditional IRAs or 401ks, you're sitting on a deferred tax bill that the IRS will eventually collect through required minimum distributions. A smarter advisor can help you move dollars from traditional accounts to Roth accounts in lower income years, paying tax now at a lower rate to avoid paying more later. Over a 20-year retirement, that kind of strategic thinking can save tens of thousands of dollars. So it's not about avoiding taxes, it's about paying what you legally owe, but not a dollar more. So pillar 3 is portfolio construction and rebalancing, which can save you or earn you, I should say, 3.3% to 0.5% per year. So investor has a risk tolerance, right? So here's the thing. Your portfolio doesn't stay aligned with that risk tolerance on its own. Markets move. Some assets grow faster than others, and over time, your portfolio that started at a thoughtful 60 stocks, 40% bonds drifts into something more aggressive or much more conservative than you ever intended. And depending on if you're drawing from those, that can have a super big impact. So rebalancing is the discipline of periodically resetting your portfolio back to what you want the allocation to be. Sell what's grown, buy what's fallen, enforce the buy low, sell high discipline that most investors struggle to do on their own. Vanguard research attributes roughly 0.35% per year to disciplined rebalancing. That may sound modest, but it's consistent, it's systematic, and protects you from the risk of being overexposed to stocks just when the market decides to correct. If you've been invested through 2022 or 2020, you know how important that protection is, right? So equally important is portfolio construction itself. Building a diversified portfolio with low cost and clear asset allocation strategy. Advisors who use cost-efficient investment vehicles like index-based funds and ETFs save clients an estimated 0.45% annually in fund expenses. So that's money that stays in your account, compounding for you, not going to fund the company. So pillar number 4, we're going to talk about withdrawal strategy. So this can make you between 0.5% or 0.7% per year. And it can, we've seen it really support people if you do the withdrawal strategy in the right way. So it's a pillar that a lot of people don't think about, and it's really consequential if you're retired, right? Because you're drawing that money out to live on. So the question is not just how I grow my money. The question is, how do I turn my money into income that lasts as long as I do? So the wrong withdrawal strategy can devastate a retirement, something called a sequence of returns risk. The danger of significant market decline in early retirement can permanently impair a portfolio. If you retire in a down market and begin drawing 5% or 6% of assets in year one, you lock in losses that your portfolio may have never fully recovered from. So I encourage you to Google sequence of returns risk so you kind of understand that. It's something that's real and it's something that can happen. So we always help our clients withdraw intelligently. So which accounts to tap into first, how to use guaranteed income sources like Social Security, maybe an annuity, to reduce portfolio dependency in the early years, and how to adjust the distributions in down years to preserve capital for long term. So now I had one client that used his cash flow life policy to do that. And so he went about 8 months living off the money that he'd saved up in a cash flow life policy. And then when the market was good, he switched back to pulling from his money that's in the market. And so he did not realize those losses. So there's an alternate account that you can draw from when the market's down, so that you're not pulling money from the depreciated asset that's gone down, something that's lower than it was. You're selling at a discount. Let's not do that. All right. So Morningstar's research found that optimized withdrawal strategies, what they call gamma, can generate the equivalent of 1.59% more annual income in retirement. That's not from better investments. It's just from better, smarter distribution planning. So add it all up. Behavioral coaching, 1.5. Tax efficiency, up to 1%. Portfolio construction and rebalancing, 0.8%. Withdrawal strategy, up to 0.7%. So the Vanguard's estimate of the total advisor alpha is up to 3% per year in net returns. That's 3% every year after fees. That is the research-backed value of working with a qualified financial investor. So you've just heard about the 4 pillars of advisor alpha: behavioral coaching, tax efficiency, portfolio construction, and withdrawal strategy. Together, they add up to 3% in net annual returns. That's the number from Vanguard's own research. On a $500,000 portfolio, 3% over 20 years is between a comfortable retirement and a compromised one. We're talking hundreds of thousands of dollars. So here's the urgency. Every year without a strategy is a year that value is quietly eroding through unnecessary taxes, through emotional decisions, through a portfolio that isn't aligned with your actual retirement goals. So we can help. Nolan Financial Partners specializes in retirement planning strategies that protect your wealth and put it to work smarter. And right now, the first step is completely free. Call 719-210-4242 to schedule your complimentary consultation. That's 719-210-4242, or go to nolanfinancialpartners.com. Don't let another year of value slip by. Give us a call, 719-210-4242. So I want to go back to the Dow bar data for just a moment. There's detail in the 2026 report that I think deserves some more attention. So in 2025, the behavior gap narrowed to just 0.72%, the smallest it's been since 2012. So that sounds like great news. And in one sense, it is. Investors stayed more disciplined in 2025 than it almost any year in the study's history. But here's what I want you to think about. The gap narrowed in a year when the S&P 500 returned nearly 18%. When the market is up 18%, almost everyone looks disciplined. The test isn't how you behave when everything is up. The test is how you behave when things are going sideways or down. Because in 2024, just 1 year before, we saw a behavior gap of 848 basis points, nearly 9 full percentage points. So that's the second largest gap in a decade. That's a year when market conditions got uncomfortable, when uncertainty crept in, and when headlines made people nervous. And that's when the gap blew open. So this is the fundamental strategy that you should look at and think about when you think about investor behavior. Good years mask bad habits. So when markets are rising, undisciplined investors look almost as good as disciplined ones. When markets are falling or even just uncertain, the gap between coached and uncoached investors becomes enormous. So it's kind of, now we're going to look at the withdrawal problem. Dalbar's 2026 data flagged something else that caught my attention. Total withdrawals from equity funds in 2025 reached 6.91% of assets, with that record monthly spike of 2.3% in that 1 month of July. So even in the year the market ultimately performed really well, investors were pulling money at historic rates. Now, some of those withdrawals were planned, people in retirement taking distributions, rebalancing to bonds as they age, executing a deliberate drawdown strategy. That's fine. That plan's working. But a significant portion of those withdrawals are reactive, fear-driven. People who saw their account balances dip in July and decided they couldn't stomach the uncertainty anymore. And every one of those investors, if they didn't get back in at the right moment, missed the market's subsequent recovery. This is the insidious thing about reactive selling. You need to be right twice. You need to sell at the right time, and you need to buy back at the right time. Research consistently shows that individual investors are almost never right both times. They sell near the bottom and they buy back near the top. The behavior gap isn't an accident. It's the mathematical outcome of trying to time a market that can't actually be timed. So what coach investors do differently? So if they have a good advisor, they don't do nothing. That's not right. That's not what's happening. That's a misconception. Good advisors are very active during volatile periods. They call clients, they send updates, they review allocations, they ask questions. They're the voice that says, I know this feels scary, but let's look at where you actually are relative to your plan. So what does it react? So they don't chase last quarter's winners. They don't capitulate at market lows. They stay anchored to the plan they built, the plan that was constructed for exactly those kinds of moments. Vanguard's research describes this as the single greatest potential value an advisor can add. But portfolio selection, not investment analysis, keeping you attached to your long-term objectives when short-term noise is doing everything it can to pull you off course. So the biggest risk to your retirement isn't a market crash. It's your response to a market correction. So Dalbar's research is clear. The behavior gap, the difference between what market returns and what investors actually earn, has averaged hundreds of basis points in volatile years. That gap is closed by discipline, by planning, by having someone in your corner that keeps you anchored when the headlines are trying to pull you off course. So your complimentary consultation is waiting. Give us a call, 719-210-4242. No cost, no obligation, just the clarity you've been looking for. Give us a call, 719-210-4242. Okay. I want to address something directly because I know it's on a lot of people's minds. The most common objection I hear working with a financial advisor is this: I don't want to pay the fee. I can do it myself. I'll just put my money in an index fund and leave it alone. You know how many times I've heard that? It's not a terrible plan. Index fund, it's legitimate. It's an evidence-based strategy, right? But I'd rather see someone in a low-cost index fund than a high-fee actively managed funds with poor track records. So you've got to look at track records. You got to see where that actually shows about self-directing, what you hear. And I want you to hear this carefully. A recent smart asset study found that investors working with financial advisors earn approximately 2.4 to 2.8% higher annual returns compared to self-directed investors, net of fees and inflation. The study is consistent with Vanguard's estimate of up to 3% in advisor alpha. These findings converge. Professional guidance applied consistently adds substantial measurable value. So let's look at real numbers. A 45-year-old with $300,000 saved, self-directed at 6% annual growth over 20 years. They accumulate $960,000. The same investor working with an advisor at 8.5% net annual growth accumulates $1.93 million. That's a difference of nearly $1 million. That's $1 million from the starting point because of strategy, discipline, and professional guidance. The fee objection misses a critical point. The cost of not having an advisor isn't zero. It's just not seen. It's invisible. It's not there. So these costs don't show up on a fee statement. My costs show up on a fee statement. And you may get mad about how much you're paying me to help you out, but realize that because my fee is explicit, it's transparent, you can see it, doesn't mean that it's not worth it. Russell Investments puts the total value of having an advisor at approximately 3.54% annually, accounting for behavior coaching, rebalancing, discipline, and tax planning. Okay. So the cost of an unmanaged portfolio drifts up as time goes. The longer you go without a good advice, the longer you will not have as a better return, right? So has your advisor talked to you about tax efficiency? Are you your own advisor? Have you talked to yourself about advise, your tax efficiency? What is your tax efficiency plan? So action 1, know your behavior risk. Pull up your account statements over the last few years. Look and see what changes have made. Look at how you behaved. Audit your tax situation. Know what your effective tax rate is on your portfolio. Number 3, review your portfolio's drift. You have a target allocation. Are you still in line with that? Make sure that you're set up for the right way that you need to be for the right time of your life. Have the withdrawal conversation. So within 10 years of retirement, and you need a clear written withdrawal strategy, right? Number 5, get a second opinion. Whether you have an advisor or not, it's time to get a second opinion on what you're doing. Make sure you understand what you're doing. So we started the program with a simple but powerful question. What is the true value of working with a financial advisor? The answer, backed by 32 years of research from Dalbar, by Advisor Alpha from Vanguard, from Morningstar's Gamma Study, by Russell Investments data, is up to 3% per year. It's not a marketing claim. It's a measured, documented, peer-reviewed research. So if you like what you hear on our show today and you want to have that second opinion, no cost, no obligation, give us a call, 719-210-4242. Visit our website, nolanfinancialpartners.com. Give us a call, 719-210-4242.